Welcome in, folks. We got some interesting videos to react to here today. Tom Lee went on CNBC a few hours ago. Want to react to what he said about stocks, the market, where things are going from here. Dan Niles spoke as well on CNBC here today about the Mag 7 and the opportunities outside of the Mag 7. Stocks, want to react to that one. The Professor Jeremy Siegel, he went on CNBC. Man, they got all the big guns out there today, right? The Fed is taking a risk it doesn't have to if it cuts rates too slow. I want to react to that one. And then last one we'll react to is a 50 basis point cut in September could cause market panic. Ooh, baby, okay? That should be an interesting one. Do you know who turned 94 years old today? It wasn't me. No, it wasn't. It was one of the greatest investors of all time, Mr. Warren Buffett, okay? The Mr. Buffett. So I want to go ahead and at the end of this video here today, I want to kind of talk about some of his positioning in the market, what stocks he holds that I like or don't like, and how his portfolio is positioned here with Berkshire Hathaway and all those sorts of things, okay? Appreciate y'all joining me as always. Thank you so much for being here. Thank you for being subscribed to the channel. I think we're at a new all-time high subscribers in the history of the channel. I believe it's 49,500 plus. Let me know if that's accurate. Might be, might not be. Hope you guys made some money this week or at least got some good deals out there. One of the two. Let's jump into this.
Clarify, we'll only have gains if it continues its strong session today, so it won't be significant net gains. Tom, great to see you. Long time no speak.
Honest is honestly just a beautiful stock, eh?
First and foremost, what's your reaction to how the market is processed Nvidia's numbers? It, of course, fell initially in the pre-market. Yesterday morning it was doing all right, and then it did close more meaningfully down by the end of the session yesterday.
Well, I think Nvidia is one of these stocks that has become part of like a stock market lore. Almost everyone has a position, and I don't think the results and the earnings changed anyone's minds about AI and the central role it's playing in both global productivity, but also NVIDIA's role. But I think the sell-off tells you that a lot of good news was priced in. I think that's why the stock fell. It didn't take the broader market down. I think that was kind of a positive outcome, and I think it just shows you that there's room for a lot of rotation, and I think that it's revealing that small caps is one of the groups benefiting from that rotation.
Let's talk about that rotation, Tom.
The reason NVIDIA wouldn't take the whole market down, right, is you got to remember NVIDIA's a very specific company in a very specific niche. And they're really the only ones that are really benefiting there from, obviously, the hardware, right? The AI chips right now in a massive, massive way. And so if you think about companies that could take the whole market down, you know what companies those are? Those would be actually more like advertising companies. Like, let's say, Google came out really bad numbers, or Meta or somebody like that. Because then people could look and they say, oh my gosh, the economy's bad. Right? Like if those stocks went down, people get freaked out about the whole market, the economy, those sorts of things. Apple can be one of those stocks sometimes that's kind of viewed in that way. Amazon can be one of those stocks. NVIDIA is such a specific niche that, like that company can do phenomenal even though there's a ton of consumer companies hurt, right? Consumer sentiment's been horrible. NVIDIA numbers have been great. They're a very special company because they're selling to the big, huge, massive tech companies. As long as those companies keep putting in these orders for these AI chips, that's all that matters in the end.
Extent to which there's still a long way to go if you're looking at the valuations of some of those sectors that haven't done so well in recent months and years, or whether things have bounced enough across the board that you start to get a little bit concerned about valuations for the entire market, not just the NVIDIAs of this world.
Valuations are definitely something our clients are asking us about because, the equity markets have been rising for several years. But the idea of a rotation, I think, is grounded on a couple of things. One is that the Fed's rate path is lower, and that benefits cyclical stocks and small caps. And we know there's also a lot of cash on the sidelines, and investors de-risked because of the yen crisis and just general concerns about the summer. And so I think the NVIDIA results plus the Fed in September is really the catalyst that is going to get some investors to actually follow through with the rotation. So I think we're early because, for instance, small caps, I know people think they're expensive, but the median PE of a Russell 2000 stock is still 10.7 times forward earnings. That's compared to almost 17 times for the S&P. So the small caps have a lot of room for multiple expansion.
But Tom, do you want to just own the index? I mean, there's a lot of not great companies when you talk about small caps, in terms of just...
In all due respect, though, sir, same thing could be said about the S&P 500. There's a lot of crap companies in the S&P 500 that you wouldn't really want to own.
Their indebtedness, but...
You should always, as an investor, focus on the best of the best. Buy the best 10, 20 stocks that you believe will perform the most tremendous over the next 5, 10 years. Let everything else be what everything else is going to be.
Number of other metrics you might want to use. Are you telling people they should buy individual stocks or just buy the index?
I think it's both, David. We have a lot of portfolio managers that actually focus on small caps, and they're finding a lot of really attractive individual ideas with good earnings growth. But I think there is a misconception about the Russell 2000. I know there's many non-earners, but over 70% of the non-earners in the Russell 2000 are biotech stocks, and I don't think they're meant to generate...
Oh, wait just a moment. Holy smokes, this ain't no joke. Tom Lee had PayPal up there. I didn't know Tom Lee was a PayPal fan. Oh my gosh, Tom Lee, you'd be flipping my flapjacks.
Earnings, and if you look at Russell 2000 earnings in aggregate, it rose 18% of the quarter, and it's projected to grow 39% in the third quarter. So in aggregate, it's not a bad index to own anyways.
Tom, I wanted to get your thoughts on the broader economic data. This morning, PCE came in...
I don't track all the small caps, right? But what he's saying might hold some weight there, because the small caps I own, all the fundamentals of all those companies are getting better. Revenues are going up, profitability improving, margins improving. Like all those companies, like Honest, Fubo, Planet, all these sorts of companies, the margins are now heading in the right direction. The revenue's heading in the right direction. The profitability's heading in the right direction. So, just looking at the small caps I own, I'm seeing that play out. And I wouldn't be surprised if it's more companies than just the few that I own, right?
With expectations, we had GDP yesterday at 3% versus the 2.8% estimate. As we start to get ready for an interest rate cut, how much is already priced into this market?
We'll never know how much good news is priced in, but I think there was a lot of encouragement in both of the data points you point out. PCE Core came in at 0.16. The upside driver there was actually financial services, which is because the stock market's up. It's showing up as inflation in PCE Core. The year over year is staying at 2.5, 2.6, which means most people were thinking that year over year would actually tick up. They had negative revisions for the prior months. And on the inflation side, a 2.8 for UMich 1 year, that's pre-pandemic levels of inflation. Consumers are always around 2.8, so
True.
I think this is giving the Fed a lot more green light to cut and focus on keeping the labor market strong, which means it's essentially acting as a Fed put going forward.
Alrighty, appreciate Tom Lee's thoughts there. Next one up here, Dan Niles.
Dan, I saw a really interesting stat in the producer's notes for this segment from you, which is that the Mag 7 have now declined on average 4% the day after reporting results versus rising 4% after Q1 results. Does that suggest to you a sentiment shift or a fundamentals shift?
Well, it's clearly a fundamental shift, because if you look at the results of the Magnificent Seven and you forget all the hype, after Google reported, their forward revenue estimates went down. After Amazon reported, their forward revenue estimates went down. After Microsoft reported, their forward revenue estimates went down. So I know it's popular to talk about AI because these stocks are driving the market, but at a certain point, you want to get a return on all of this money you're investing. And if your forward revenue estimates are going lower, not higher, but your CapEx is going up, at some point, those two things are going to collide. And we saw this after COVID, where spending took off and then slowed down dramatically as these same companies went through a digestion period. And that's what I think you're going to see happen as we get into next year.
The digestion period indicating that there needs to be a very clear ROI on all of this CapEx spending, which some investors feel dissatisfied by.
Exactly. And
which, by the way, if that does play out what Dan Niles is talking about, which that's a realistic possibility, that's going to mean bad things for NVIDIA's revenue in 2026. That's going to mean NVIDIA is going to be, flatlining revenue in 2026 or going down, or very slight growth. And any of those scenarios is a disaster for NVIDIA. A scenario where they barely grow, a scenario where they flatline, or a scenario where their revenue goes down in 2026, any of those is a disaster for NVIDIA, and that would start hitting the stock heavy, obviously, in 2025, if that was to play out, right? But that is something to kind of keep in mind here. And geez, like that would be rough. Like NVIDIA really needs to keep putting up these, big growth rates. Like 2026 even, they want to, you would want to see them growing like 20% plus. I don't know if they got it.
And you can think about it just from looking at NVIDIA, the poster child of AI. During COVID, obviously, everybody had to get online, and all of these same hyperscalers went ahead and spent a lot of money. And if you go back and you look at it, during 2021, revenue growth for NVIDIA was up 62% year over year. 2022, revenues were up 6%, and the stock went down from peak to trough 66%. And so if you look at CapEx spending over the last 2 years, and you see NVIDIA's revenues last year grew over 100%. This year, they're going to grow over 100%. I think what you're going to see next year is a dramatic slowdown, not only from the spending from the hyperscalers, but also in NVIDIA's revenues as those hyperscalers grow into all of this money that they've spent that's not actually generating an increase in their revenues. And so that's what you're going to have to deal with. And we've seen this after COVID. But investors obviously don't want to believe this because it's going to be really painful. But you can see it in the revenue figures for the big hyperscalers and how they're going down, not up, after they report it.
Is there an argument?
So the difference with NVIDIA, I think this go round though is, so in the last one, obviously NVIDIA stock crashed insane, right? He spoke about there. I think it was actually down closer to 70%. But anyways, whichever way you want to slice it, 60%, 70%, it was a massive number, okay? I'm not actually expecting that epic crash to happen next time with NVIDIA, that 60, 70% drawdown. I think it is very much a possibility that NVIDIA stock could just kind of like stagnate. Let's call it in the $90 to maybe $125 range for several years. That's a potential. It's not like all the time like a stock has to crash and it's like the end, right? It could literally just stagnate for several years. And so the company maybe keeps growing, but also those growth rates come way down, right? And people start to look at it and they're like, well, it's not like it's that high of a valuation, but at the same time, they're not growing the way they were growing. So now the growth rates are really slow. And so you just kind of get in this stagnant kind of period with the stock where it just kind of flounders around between like $90 and let's say $125 for a long period of time, essentially. So it's very possible. Now, if the whole market crash, of course, NVIDIA is going to pull down heavy with that as well. But then you have to bank on a whole stock market crash, right? I'm just talking about if the market is in correction, if the market's in, slightly up, flattish, something like that. That's a scenario where I see NVIDIA just kind of floundering for maybe several years in that sort of dynamic. So I think that's a real potential and it's something that should be considered.
I mean, we get PCE in about 8 minutes. So I have to ask you a rates-related question as it pertains to CapEx, which is that a lot of what we've seen over the last few years has defied kind of Econ 101 in terms of CapEx spending because of this clamoring for AI, as well as the enormous amount of cash on the balance sheets of large tech. But as you do see rates come down, is there an argument to be made that more of the CapEx spending could be kind of built up by those who haven't necessarily been spending because financing that CapEx suddenly becomes cheaper?
Yeah, I think if you think about the market, July 16th, that's where the S&P hit its peak, and the S&P is down about 1% from there. The Magnificent Seven are down 8%, but the equal weighted S&P is up 2%. And so we've been saying this for a while. In terms of what we're looking at to invest in, it's the areas that benefit from rate cuts. And so it's areas like consumer staples, utilities, telecom services, other sectors of the market, because it's that other 493 stocks is our belief that drives this market to new all-time record highs. And we still don't get me wrong, we like Apple, we like Meta, because there we see revenues actually doing well. They had forward revenue estimates go up. But I think you really have to look outside of just 7 stocks through the rest of this year, because rates going down is going to benefit a whole lot of other sectors of this market, just like you brought up.
Yeah, you're working with about 70% of the S&P market cap, I guess, if you're talking about the 493, trying to drive the index to new highs. I guess, Dan, for that to happen, you must assume the economy is going to hang together pretty well. Therefore, earnings growth can spread out among more companies.
Absolutely, Mike. I mean, we look at jobs as the number one driver of everything. And if you think about this whole debate of, what's the economy going to do? It's hard for me to imagine the economy slows down that much if you've got 10% more job openings than people unemployed. And this is the same reason why several years ago we were saying this is not transitory inflation, because you had 2 times as many people, 2 times as many job openings as people unemployed. So
that's a point I've definitely been making for a while now, but I will push back against my own point there about this whole job openings. And it's come to light recently that it's easier than ever to kind of create like fake job postings. So why companies would want to do that is, let's say they don't even really have a need, but they just want to throw it out there, see if they can get some incredible candidate, right? That they maybe could use in their company. They'll put a job posting out there, right? And have a ton of people apply for it, maybe not even hire any of them. And really, they don't even really have that role in reality, but they put it out there just to see, like, do we attract a superstar, right? And if they do, great, then they could hire them for, even if it's not that role, maybe like something inside the company, right? But it seems like more and more companies are doing that as a way of recruiting to like build their catalog of people, right? Or just have more people to reach out to in the future. Let's say they do have to go through a hiring spree and company XYZ has to hire 200 employees all of a sudden, right? Well, if you've been collecting all these ridiculous amounts of applications, you went through a lot of interviews, even if you weren't ready to hire them at that specific moment, maybe you can come back 6 months, 9 months, 12 months, reach out to them, say, hey, you know what? We have a job opportunity. We spoke to you back, 10 months ago and you said blah, blah, blah. We have a position available here, salary starting at. And so I do think there's a lot of that. It's just we don't know how much. We know there's a pretty good amount of fake job postings out there. Fake job openings. Like truly they're fake, but we don't know how much. Is it like 3%, 5%, 10%, 20%, 30%? We don't know. It's a number, and I think it's something at least decent, but we don't know how much, right? And that's a little scary.
That you look at GDP running around 3%. You look at the fact the Fed's going to cut probably 3 times this year to get the Fed funds rate closer to where inflation's actually running. Obviously, we're going to get the PCE report very shortly. But you look at all of that and you say, okay, this should be good for the economy in general, and these other stocks that people have forgotten about, who I think will do pretty well over the course of the next 12 months, where a lot of the Magnificent Seven, I think you're going to see their revenue growth actually slow down a little bit. But that's not a bad thing. You can have these other 493 stocks actually doing quite well, which is what we've seen since the middle of July.
So then would you be using any dips in the Mag 7 as buying?
And I'm not seeing all those, I was seeing in Vegas, if we go back a year ago, 2 years ago, so many now hiring signs. It seemed like everywhere I went, didn't matter if it was a fast food restaurant, anywhere, it was now hiring, right? I'm not seeing that anymore now at this point in time. So I do think that's also something kind of interesting.
Opportunities, or at this point, given just the estimates in the future, you'd be sitting that out?
Well, right now, the two that we like Apple a lot. I mean, Apple's had very little growth for the last 3 years. It grew 4% 2 years ago, it grew 0% last year. Sorry, 2% 2 years ago, 0% last year, 4% this year. I think next year, driven by people actually upgrading their iPhones, which they last did during COVID, you're going to see that growth rate be over 10%.
Yes.
And so I think that's very interesting. Meta's very interesting. But you look at the other names in there, I think NVIDIA is going to go through, obviously, CapEx digestion, which we've talked about. Microsoft should worry you because despite their relationship with OpenAI, they missed their Azure numbers. Amazon, obviously,
True.
E-commerce, I thought there would be share gains. They could do that profitably. Margins came in worse than people thought. And with Google, I don't see how they keep 90% plus share in search when you've got all of this spending on AI going on, and you got to believe some of those companies take share. And then Tesla's just obviously in a tough competitive environment. So It really, you got to go through each one individually.
So what he laid out there, that's actually really interesting, because I think this is really, we got to talk about this, what he just laid out there. It's very important. Listen, okay? Big tech. He just laid out a wall of worry for big tech, right? And if you go through them all, he kind of just went through it. I think that's actually really important in terms of the wall of worry, and that this is the first time we've had a wall of worry around big tech as a whole in quite some time, because every company you could poke something at, right? Amazon's growth rates were kind of a little disappointing. As an Amazon shareholder, it's a big position for me. I was kind of a little disappointed in those growth rates. Tesla obviously is no secret. Like it's been extremely disappointing in regards to numbers for at least a year now, right? If you want to go to NVIDIA, there's a wall of worry that's starting to build with NVIDIA about a slowdown in chip orders at the end of 2025 or going into 2026, right? That's starting to become a wall of worry. If we look at Google McDougal, they have a huge wall of worry. The government's coming after them. Now they got these big lawsuits. On top of that, OpenAI is a major competitive threat. So Google McDougal, there's a wall of worry certainly around there. Microsoft, with the Azure numbers, as you point out, wall of worry there. Meta, it's hard to make a case around Meta. The only wall of worry I could try to build around Meta is revenue growth is decelerating. So it's not going up as rapidly as a percent. It looks like going forward. That's a really difficult one to make a wall of worry, but if we got to do it, we'll do it. Apple's numbers have been very disappointing. They should get better, much better in 2025. I believe that. Dan Iles believes that. But with that being said, they have been very disappointing numbers, so we certainly have a wall of worry around Apple as well. And so that should take us through the full Mag 7 there. And so you have a wall of worry around those stocks, right? And that's interesting because it wasn't like that for a while. For a while, this wall of worry just recently emerged. Like when I say recently, I'm talking really in the past like 3 months or so. This wall of worry has really emerged. And, hey, if anything, that's good because a lot of people like to buy these sorts of stocks. And so you usually want to feel like there's a wall of worry going around those stocks when you're buying, right? You don't want to feel like you're buying when everything's seen as perfect. The Professor Jeremy Siegel.
Happy to see you. I'm older than both of you, and I always wear a necktie. So I guess it's the old generation. I don't know.
You're older and wiser, and that's why we're looking forward to hearing your perspectives on all this. I mean, bottom line on this PCE data, are we definitely going to see a rate cut, and is it almost certainly going to be 25 basis points?
Well, I think whether it's 25 or more, really, as you mentioned, depends on what we see next Friday. And there's even, some more reports coming before that September 18th. So, it's definitely going to be a cut. I think it's open between 25 and 50. I think it was really interesting, Wilfred, you're mentioning about what's going on in the Eurozone's lower. They have a different method of computing the housing. And I've been on the Fed for so long saying their housing measure is lagged so much that it keeps on feeding in, even though, we have rental prices that have stabilized. They don't have that problem in Europe. And that's one reason I think it's further down. When I actually put, on the ground housing prices in, I actually get 2% or even below on year over year inflation. I think the Fed is there. And, I think, to stay at 5.33, well, they are going to go down. But, my feeling is they should move much faster towards what they say is the neutral rate. Now, in that June meeting, they say it was 2.8%. We're going to get a new read, new dot plot in 2.5 weeks. It may go up to 3, but that's still, over 200 basis points lower than where it is today.
Are you saying that, Professor Siegel, because you think, in fact, the inflation numbers give it the room to do so, so they may as well do so? Or is it because the economy is also weakening at a faster pace than they're perhaps appreciating?
Well, I am worried. I mean, certainly, I got worried with the last report, and it looked like those claims were heading way up. I get worried when they go above 240. Now they've stabilized down on 230. We shouldn't get too excited. We saw that 3% print, but that was April, May, June. We're, just on the verge of September. I was a little disturbed, for instance, the trade report yesterday didn't get a lot of, press because it was, overtaken by everything else. But the Fed, the Atlanta Fed, and several others are going to come out with a report later today. Believe it or not, I think this quarter might have a one handle on GDP. So, yeah, now that's not recession, and I'm not saying recession, but it is a slowdown. And I think that, given that slowdown, given that the unemployment rate rose to 4.3%. That is above the Fed's long-term target, given we were within 0.5% on their own measure of their inflation target. My feeling is they should be closer to what they say is the neutral rate rather than tiptoe down, well, quarter point here and there, we'll get there eventually. Why take that risk? Be bolder. They were 75 basis points on the way up. For sure, They were way too late, and I'm not saying they should panic, but, lower, I think, is the better.
Although,
option.
Jeremy, you got a lot of attention not that long ago when you were on our air talking for an emergency rate cut, right?
Yeah,
Everybody was like, oh, my God, what? And you do seem to have backed off a bit from that. What was it you were seeing then that you maybe aren't seeing now?
Well, what I did see was that labor market and as I said, the claims report going considerably up. And I said, I saw the Psalms rule being triggered. I saw a number of other rules being triggered. And then I said to myself, well, why is the Fed at 5.3 when they say, it should be at 2.8 when it's long term? Now, I will absolutely admit, things calm down, the economy looks good. But, let's put it on, even if
that goes to show you how much the stock market can influence how people really feel. Jeremy Siegel, the professor here, he's not been influenced by, the economy's great now. If anything, we've got even more bad data since then. We got the revision, 818,000 jobs revised down, right? That certainly wasn't good. Earnings have been shaky. Some companies have been doing really well if it's a really, top tier company, but a lot of companies have been struggling, right, with their numbers. So I don't think between that August 5th day, right, that Monday, and now at the very end of August, has there been some monumental shift that the economy is so great now, everything's phenomenal? No. If anything, you've got an argument that you can make a further weakening, right? It's just the market bounced back strong. And so because the market bounced back strong, everybody starts feeling, you know what, the economy is okay. Everything's fine out here. If all of a sudden, this is how fast it can happen. Send the Dow down 2,000 points. It can't happen Monday. Send it down Tuesday. Send the Dow down 2,000 points and watch everybody flip out. Send it down another 1,000 points on Wednesday. And everybody will lose their mind. The economy's in shambles. The Fed's got to start lowering. Emergency cuts. What's the Fed doing up here? Believe me, it's how fast it can shift. It doesn't have to be anything. Like, once the market moves a certain way, everybody starts feeling a certain way. And it happens like that, right? Everybody starts saying, oh my gosh, the economy's a disaster. The Dow's going down, right? The Dow's moving up and everybody's like, it's okay. It's okay. You get the same exact data points. But which way is the market moving? And it will dictate the way these Wall Streeters feel, which is very interesting. Very, very interesting.
He is at 2%, which is, let's say the long-term target. That doesn't argue to stay at 5.3 when you're that close to target. Some people are saying, the economy's fine, leave it where it is. That's not the logic of the Fed. That's not what they say, unless they really think the Fed funds rate should be, 4.5 to 5 so they can tiptoe down. I don't hear that from anyone. So my feeling is I'm not quite sure why being so close, 80 to 100% there on unemployment, over 100% there, they are tiptoeing down so slowly on Fed funds.
So, Professor, tell us what this all does for your view on the S&P 500. If we've got 100 basis points priced in by the end of the year, we're probably not going to get more than that. With that in mind, do we also have to see the economy land softly? If it worsens, will rate cuts do enough to prop up the S&P 500, or do you kind of need a bit of both with where we are at the moment?
Well, as you know, the long bond is saying the Fed is going to be more aggressive than a lot of people think, and probably even than the dot plot. I mean, if you look forward to the June of next year, you see quite a number of cuts. So in some ways, the bond market is kind of doing the Fed's job for them, bringing down that mortgage rate, which is due to the 10-year. However, we should remember that a lot of small firms, as well as individuals, they don't finance at the 10-year if you're not buying a house. They finance at the prime rate. and what used to be called the LIBOR rate, now it's called the SOFR rate. Firms finance at that short-term rate. That's one reason why small firms have been hurt so much more than the large firms by the rise of interest rates, is because they are much more short-term oriented. That lowering of rate, I think, would really help those smaller firms and would help the dividend-paying firms. I think a lowering of rates aggressively is really needed to turn that scenario around.
Yeah. So does that mean you want to stay away from sort of the mega cap part of the market, so to speak, and kind of lean into this broadening theme we talk so often about?
Well, I mean, I certainly think there's a reason for that, and I like those relative valuations. I just don't want the Fed to go down too slow. So if the data looks weak and they only go down 25 basis points, then I get more worried. Again, slow down to maybe 0 to 1% for 2 or 3 quarters. I mean, we've got to be negative for a recession. Actually, even more, a little bit than that. We had 2 quarters actually a couple of years ago. We had negative. We didn't call it because the unemployment rate didn't go up. But now we have that unemployment rate. I'm not calling a recession. I'm just saying the Fed, if it goes down too slow, is taking a risk that I don't think it has to take.
So let me explain why it's such a flawed way of thinking in regards to economics, in regards to thinking about where things are today and what the Fed should be doing, okay? So if you look today and you feel like, oh, the economy is fine, we're at unemployment rate of 4.3, 4.4, or whatever, right? So then the Fed doesn't lower. You got to understand you're making a big mistake. There's what's called the Fed lags, okay? The Fed lags take how long to really catch up? 1 to 3 years. 1 to 3 years. So between now and a year from now, so much can change. If you're thinking 2 years from now, you know how much can change in 2 years? Do you know how much can change in 3 years? That's how long it takes for the Fed, when they start lowering rates or raising rates, to start actually positively affecting the true economy, okay? And so it's a flawed way of thinking. It's no different than, the Fed waiting till, March of 2022 to start raising interest rates. By that time, inflation was already flying and was already in your face. If you wait to start lowering rates until it's clear you're already in a recession, you're going deep in the recession. Deep. Because by the time you start lowering rates, if you're already in a true recession, if unemployment's already spiking majorly, you know how long it's going to take for those lowering of rates to really start positively affecting? You still got to go through the whole down cycle. It's a process. It's not like the Fed lowers rates and tomorrow, it changes everything. No, it's a process that takes time. And therefore, if let's say you're looking at the economy, you're like, okay, things are a little bit worsening here, which you can make a debate that things are worsening. At the end of the day, when you see unemployment ticking up continually, are things getting better or worse? They're getting worse, right? So you look at that right now and you say things are getting worse. We need to start getting out in front of this. We need to start lowering, right? You could make an argument that they should have already started, but let's just say they should start lowering ASAP, right? In September, let's say, for instance, to try to get ahead of that. So then let's say you do actually hit, an unemployment rate of, next thing you know, it's 5%, 6%, 7%. By that time, you've already lowered rates substantially. So hopefully those Fed lags can start to catch up and start to kick in and actually help things, right? But if you're just looking at what's going on today and where the Fed funds rate should be, you're in trouble, man. And this is where the Fed gets into trouble. They always talk about they're so data dependent. Well, the problem is the economy is not looking in the rearview mirror. It's what's going on in the future. Right? And so it's a flawed way of thinking. And I understand they just want to look at the data because they don't want too much opinion to be in there. But damn it. You gotta not just look at what's going on today, but you gotta try to project out what's likely to transpire. If you see an unemployment rate continuing to tick up, it continues to go up and up and up, and you're in a very restrictive state if you're the Federal Reserve, shouldn't you be moving a certain way? Right? You got to factor that in. If you see inflation getting out of control more and more, and next thing you know, CPI goes from 2.5 to 3.5 to 4.5, you should probably get ahead of that and start saying, okay, we're going to start raising rates, right? So anyways, that's why the Fed continually screws up. That's why the Fed's continually late, and that's why everybody always says, the Fed's always late. There's a reason. It's because they are always late. Next one up here, 50 basis point cut in September could cause market panic. Stop it. 75, panic. 50? Nah.
Will today's closely watch the inflation data impact the Fed's next move and the market going forward? Our next guest expects a 25 basis point cut from the Fed at the September meeting. Joining us is David Smith. He's Chief Investment Officer at Rockland Trust Investment Management Group. Okay, David, good to see you. So you expect this cut, but overall, my question is, can the market overall kind of stay this expensive, relatively speaking, and keep getting over these freakouts?
You know, it'd be interesting. First of all, happy Labor Day weekend to both of you. It'd be very interesting to see how the market reacts to the 25 basis points. We are pretty confident, obviously, like most market participants are at this point in time, that we're going to see a rate cut, and I think it's 25 basis points. I'm actually a little concerned if they did something more aggressive and moved as much as 50 basis points, because I'm concerned that the market participants may view that as the Fed seeing something scary in their economic data and then moving aggressively to get in front of that. So I think 25 basis points is pretty well on the cards at this point.
If the market was to freak out because of a 50 basis point move, the market's clueless in that situation. If anything, they should panic over a 25 basis point cut. If they only cut 25 and you're truly worried about recession over the next year and unemployment rates spiking massively, you need the Fed to start lowering more aggressively, which means 50 basis point cuts, right? So, what do you want the Fed to do? Be wrong and cut too slowly just to maybe make the market feel better? Like, should the Fed be driving policy based upon what the market feels? Is it going to feel good or bad if we cut this much or that much? Or should they be lowering or raising rates based upon what they actually are projecting or seeing in the data, right? Come on now.
And I would expect that will be the first in probably a series of 25 basis point moves as we progress through the rest of 2024 and into 2025, probably settling out in that low 3% range sometime at the end of 2025.
If they just go 25s and 25s and 25s, and we actually do end up having the hard landing, we actually do end up having that unemployment rate shoot higher in a massive way, Jerome Powell's legacy, he'll be remembered as the worst Fed president in history. If they go way too slow here at the start and they screw up and next thing you know, they're in panic mode and they have to start doing setting, I'm telling you, he'll be remembered as the worst in history. Because that would mean that he screwed up 2 cycles. He went too slow and too late at the inflation part of the cycle, right? Which he's already obviously gotten damaged for. But then if he screws up this part and they go too slow and next thing you know, you end up in a big recession, dude, you'd be remembered as the worst Fed president in the history of the Federal Reserve. And that's saying a lot because there's a few that's, a lot of people don't like, including Arthur Burns.
The next sort of big data point for the Fed, it may not matter for the September meeting, but it could matter further out, is the non-farm payrolls that we're going to be getting next week. What do you think we're going to see there? What would make a difference to the Fed's outlook?
Yeah, I don't, like you said, Deirdre, I don't think it's going to have a real effect. I think they pretty much telegraphed they're going to move 25 basis points. I think that may have broader implications for the next meeting and whether or not they'll move incrementally at the next meeting or maybe skip a meeting and make a move in the following meeting. So the September 18th, I think, is pretty well baked at this point in time. They'll continue to monitor data, the jobs data, the economic data. Obviously, today's PCE was a positive number, I think, at 2.5%. So there's lots of data flowing between now and the next meeting, and I think that will be taken into account as they assess kind of how they're going to move going forward. The only way that may impact the 18th is on the language coming out of the meeting and what Fed Chair Powell says about what they're going to do at the next meeting.
Oh, David, it just feels weird to keep looking back and forth over our shoulder at the Fed, right, as investors try to figure out what stocks are going to do. So I guess at what point do you think the focus can go back onto fundamentals and the question of whether the overall economic health, demand, the consumer strength perhaps, is such that you can trust that companies are going to be able to continue to do well?
John, great question. It feels like we've been focused on the Fed now for the better part of a couple of 3 years. And I don't know when we're going to get out of this. I suppose if we...
Listen, I've been in the market 15 plus years. They're always focused on the Fed. Always. There's certain time periods where it's more intense, no doubt, and that's usually when people are feeling like the Fed's about to start raising rates or lowering rates, and so there's like a more intense focus on it. There's more talk and debate on CNBC and Bloomberg and everywhere, and all the financial websites when people feel like they're going to start moving up or moving down. But there's always always an emphasis on the Fed. And, I remember watching Janet Yellen back in the day when I'd watch CNBC, right? And I hardly understood what the Fed really did. And I remember Janet Yellen would go on, Ben Bernanke back in the day. I remember when Ben Bernanke would go on and start talking, right? And like I said, back in those days, I hardly understood what the Fed's even there for and what they were doing, right? And they would talk about it and they would debate it on CNBC. So I can just tell you there's always going to be an emphasis on the Fed. If you think like we can get rid of the Fed and like they're not going to, no, there'll always be a focus. It's just more intense when they're about to start cutting or raising.
To a rate environment that is neither, aggressive or contracting, that will probably be at a point where then we can just look and sort of say, status quo, the economy is going to do what it's going to do. But for now, the Fed has been very aggressive, moving interest rates up to get inflation under control. That was a shock to the system. And I think they're going to begin to get into a pattern of reducing rates. I don't know how aggressively, but we'll be in a period of time now where rates will be coming down. If I'm correct, and then by the end of 2025, we sort of land at that 3% range, and the economy is chugging along at the 3%, 2% range that it's at right now, I think then we'll be able to focus on fundamentals with the expectation that the Fed's sort of out of the game. But that's to be determined. Obviously, we'll see how things play out.
Fed's never out of the game. All right, Warren Buffett, Mr. Buffett. He's turned 94 today. So looking at Berkshire Hathaway's portfolio here. Obviously, Apple's a stake they've cut recently, but it's still a huge position for them. No dang doubt about that, right? Still a huge stake for them. A little under 30% of the portfolio. The only beef I have with Apple is one thing, and let me show you what that is. It's this forward P. It's 33, right? It's definitely rich. Now, I do think Apple's going to get back to very nice growth in 2025. Earnings per share growth should be strong, and it should be stronger than revenue. So let's say revenue goes up 15% in next year, let's say, for instance, right, for Apple. That I think they're looking pretty good, but let's run a little valuation model. Let's see, is there really a good deal here in regards to Apple or not? So let's go ahead, let's run some growth rates here on 1000xstocks.com. So what do we think is a fair revenue growth rate on average for the company to grow over the next 4 years? I would say a fair number, I would say 12%, right? I would say 12% is pretty fair. I think next year they're going to grow stronger than 12%. I think 15, 20% next year, but then other years they might slack a little bit, right? Now, if you have some sort of major economic unemployment cycle and the economy gets hit heavy, like you could have that number be less, but I think 12% is about right. Net income growth, I think, is going to be higher. I would expect 15%-ish, if not higher than that. And we also know Apple's always buying back a ton of shares, which will help earnings per share, certainly, right? I would say Apple's probably fair at somewhere between a 25 and about a 35 P ratio nowadays because their services business, right? Their services business is a giant, and people look at that as just such a safe business model that's just going to be recurring. So Apple's 229 here today, right? And so if we look out to the kind of 2028, we're looking at likely a stock price of about 259 to 363, somewhere in there roughly, right? Which would be a CAGR on the low side, a compounded annual growth rate of about 3% to maybe about 12%, right? So I don't think Apple's a bad buy, but it's just not super attractive, right? Because if we pull up something like, let's run some numbers and projections here on Meta, for instance, right? So Meta, if we were to assume those same exact numbers, which Meta honestly should be ahead of these numbers that we have here, 12 and 15%, right? If we run those same exact numbers on Meta, we're looking at somewhere around a $930 stock price to about $1,300. And today the stock's $521, which gives us a compounded annual growth rate on the low side of about 16% and on the high side of about 26%, right? Keep in mind, Meta's been growing significantly faster revenues and net incomes than Apple has and should continue to over future years. So assuming a 12% revenue growth and a 15% net income growth, those are probably low numbers, right? And so that just goes to show you kind of the opportunity in Meta stock over somebody like an Apple, right? If we were to change these to probably a little bit more of a fair, in my opinion, 15 to 18%, I think that's pretty fair for this company over the coming years. 15% on average, 18% net income on average. Check out how this changes the numbers here. So then we're looking at, on the low side, the share price being a little over $1,000, and then on the high side being about $1,400, which would be a compounded annual growth rate on the low side about 19%, and on the high side of close to 30%, right? So pretty darn attractive. So, you know, Apple, good company, great company. I shouldn't say good company, great company, top tier. Not going to give you the best returns over the next 5 years, but solid, very, very solid. Now, American Express. So this is a huge position for them. Significant. First off, I like American Express's business model. I really do. Really good company, very well run, great clientele, really solid margins on this company, gross margins and net margin, about 17% here. So American Express, people are expecting around 5% revenue growth for the company and around 7% EPS growth. So let's go ahead and let's run some projections here. Let's just say they do 5% on average over the coming years. And let's say they do, I think 7% is low, but let's just say it's 7%. I think they could do better than 7% on the bottom line. But let's be really conservative with these numbers. A 20 to 30 for American Express, given how stable the business model has been over the years and how phenomenally run the company is, I think that's fair. 20 to 30 range here. So that would put the stock right now is about $72. That would put the stock somewhere between about 108 and 163. Compounded annual growth rate on the low side about 11%, on the high side about 22%. And those are pretty modest numbers. 5% revenue growth expected over the coming years and 7% net income. So now there is a potential of what happens if you did have a big recession over the next few years, which you probably will. I would say there's a high probability we're going to have a big unemployment cycle at some point in this next 4 years, right? It's just a question of, does it come 2025, 2026, or 2027? I think that's a big question. And so, you know, that could definitely hurt the net income of American Express for 1 to 2 years. So there is a risk there. This case has to kind of assume the economy is going to be pretty good over those coming years. Wait, did I do American Express? Oh, wait. I may not have typed the ticker symbol in. Silly me. Sorry. I apologize. This would put American Express, so same exact numbers here. I was doing that for PayPal, by the way. PayPal better grow better than that. That would be, it's kind of sad if PayPal only grew those numbers because they've been growing way faster than that. But American Express looking at 365 to 547 here, 9% on the low end, 21% on the high end. So I think it's decent. Not the best, right? Bank of America, I think is too messy. I don't like the banks unless it's somebody that's a special story like a SoFi, where they're just grabbing so many new customers, so many members. It's like a growth company. They got the tech side. I mean, financials just don't really interest me. Coca-Cola, Coca-Cola is as steady gets, right? But with that being said on this baby, so 23, 2-year out forward P. Next year earnings per share growth expected to be really strong, 18%, but that's obviously not going to really be a lasting number. Revenue growth of about 4% expected next year. So if we run valuation on Coca-Cola here, let's go ahead and play around with some numbers. I think 4% might be high on revenue actually, but let's run 4% over the coming years for Coca-Cola revenue-wise. 4%, let's say their net income goes up quite a bit more. They keep expenses really in check. Margins pick up. 6% there. I think Coca-Cola should be somewhere between, in my personal opinion, about an 18, I would say, on the low end for the stock. 18. Ow. 18. You remember that song? And I would say about 25 on this baby. 25. I think that's fair for Coca-Cola. Obviously, very stable business model. Not much growth, but it's very stable. So, $72 stock price today, it's not interesting. Even remotely, it's just a waste. Now, obviously, you're going to collect dividends over that time, but still, Nope. No, thank you. Chevron and Occidental Petroleum, that's going to really be so dependent upon what happens in this next energy cycle here. Moody's, Kraft Heinz, it's just a lot of these companies I just don't like, man. I just don't like. Kroger, big position for them here. They own several different Japanese stocks. They're really bullish on Japan, obviously. Visa, It's a kind of an interesting one. It's a little less than 1% of the portfolio in MasterCard. Yeah, they obviously Buffett loves these sorts of business models like a Visa, like a MasterCard. He loves them to death. Now, for Visa, that's probably low. I would say 7%-ish is a conservative, comfortable number to be at for Visa over the coming years. And I would say when it comes to net income, I would probably run about 11% here for Visa over the coming years when it comes to their net income. And as far as P's go, I would go 20. I think 20 to 25 is fair for Visa. 20 to 25 on this baby. So, just not a great CAGR in regards to this one either. And I think those are pretty fair numbers. 7% revenue growth on average over these coming years and 11% bottom line. I think that's pretty fair. So just the CAGR is not appetizing in regards to this one. So, Visa, very solid company. And that's the thing, Buffett owns a lot of really solid companies. It's just, given the valuation these stocks are trading at right now, they're not super, super appealing. Amazon is a position for them. I'm pretty sure it's either Todd or Ted were the ones that bought those shares. New Holdings, that should be a financial if I recall. It's interesting. Ally, I like Ally. I don't love it, but I like it. T-Mobile, Charter Communication, Cirrus Holdings. Floor & Decor is a good company, really good company, but the problem with Floor & Decor is valuation-wise on that one. That's another one that, so what was it, FND, Floor & Decor? There it is. So look at this baby, 64 forward P, 2-year out forward P around 38. I like Floor & Decor. This is a type of stock that I would be interested in buying, but I can't do it at this sort of valuation. We got to keep in mind, probably getting an unemployment recession in the next few years. Do you really want to be in Floor & Decor? At that valuation, not really. If it was a 20 forward P or 15, then it might be much more appealing to me because I might say, okay, yeah, we're going to have an unemployment recession at some point in time, but gosh, the forward P on Floor & Decor is so low. Here, it's not interesting enough, right? So, yeah, I mean, at the end of the day, the thing is with Buffett, he's done so phenomenal over the long term. But obviously, the last many years have been tough for Buffett. And the reason it's been tough, and I don't mean from the standpoint of Berkshire stock price. Berkshire stock price has done phenomenal. But in terms of trying to find the next great stocks, it's been a difficult, really past, I would say, 10 or 15 years for Buffett. He just really hasn't found those truly great stocks. Apple he bought at a great valuation, right? He was late to the game in regards to Apple. Let's not fool ourselves, but he still got in at a great valuation at that particular time. But outside of that, a lot of these positions have been built for a while, and it's just I'm sure it's going to be difficult. When you're trying to pick stocks and all this, imagine when that man started in this financial game in the 1950s, 1960s, imagine how much different it was than today, right? It's a whole different world in terms of the type of companies you have opportunities to invest in, the way businesses operate, the softwares and systems businesses use. It's not even, compared to when he started in this game in the 50s and 60s, it's so different. It's hard to even, fathom how different it is, right? It's crazy to think. When he first got started in this game, computers weren't even really a thing. And then computers started slowly getting used by some big companies, late 60s into the 70s. You still hadn't even been through the PC revolution, the internet, anything like that, right? You didn't finally get the PC revolution starting to come around really till the 90s. And then the internet age starting to come around really in the mid-90s, late 90s. And then obviously everything changed a lot more from there. We had the mobile revolution, we had the social network revolution, the cloud revolution, the AI revolution. Now, gosh, what a difference between how business was done then versus now. I just think about, man, if I lived to be 90-something years old, it was going to be hard to pick stocks. I'm not going to lie to you guys, because imagine how different the companies are going to be 60 years from now, right? Than when I first got started at 18, 19 years old. It's I'm going to be hard to even recognize, what's even going on. That's just crazy to think. So anyways, the GOAT, man, happy 94th birthday. I hope he gets to live to be like 120, because I think he's always got a lot of wisdom to pass on out there. I hope to see him in a lot more interviews in the future. He's still very with it, and I love to see that. I love to see how with it that man is, still in his 90s, because a lot of times you think about somebody in their 90s, you think about just like, there's not much going on upstairs, and to think about how that man can still hold a several-hour conversation or an interview or something like that is phenomenal. So love seeing it, man. Love seeing it. But anyways, guys, appreciate you joining me as always. Thank you so much for being here. If you're looking to take your investing game up to a much higher level, I'll put the pinned comment down there today, application, if you're looking to join my private stock group, private wealth group, 1000xstocks.com. Get access to all that. 1000x can obviously help you make decisions a lot better than how you're making them right now. Additionally, with my private group that teaches you everything I got up here, exactly how I identify businesses, look into them. It teaches you everything. I mean, even on 1000x now, we have a lot of educational materials that can help you out immensely. So if you go to their education portion here on 1000x, we have all these different education sections that are very in-depth. How to decode a balance sheet, how to decode an income statement, how to decode a cash flow, how to perform SWOT analysis, strength, weaknesses, opportunities, and threats, strong moats versus weak moats on business, how to value a dividend stock, how to value a growth stock. Very important to a lot of you guys out there. So I know a lot of you guys love to value growth stocks, but you don't know how to value growth stock. That's going to help you out immensely. Dividend investing 101, portfolio management 101. These lessons are phenomenal for teaching you everything you got to know about these different subjects, how it all works. I mean, second to none. So if you're looking to access all this type of information, check out the pinned comment down there. Click on that, fill out an application. We'll see if we can get you access to 1000x, my private stock group, wealth group. We'll see if we can get you access to that maybe next week at some point. All right, guys, much love and have a great day.